Hello friends, how are you doing? Welcome to a new chapter on CFA Level 2 curriculum. Today we will be discussing a valuation method based on residual income. So there are three major ways to value companies: dividend discount model, right? DDM, free cash flow valuation model, this is also there in the curriculum, and the third method is valuation through residual income. So we will be discussing this today. To know that, first we have to understand what is residual income, right? What is residual income? Now by definition, residual income is the earnings in excess of opportunity cost. Now what is opportunity cost? Let's understand that also. Let's say I was searching for investments, right? And after a certain period of searching, I found a company or a company with a certain amount of stocks available to purchase. The company's name was XYZ. And this company I projected would be giving me 10% return, right? Now I wanted to invest in that. This was the best company that I found, but in the meantime, another opportunity came up, which was company ABC. And I found this company to be much more interesting than even this one. So what I decided is, I would invest in this one and I would not invest in this one. Now, for my investment, the opportunity cost is 10%. Why? Because I have foregone this 10% return from XYZ to invest here in this company, right? I'll repeat again, I have foregone, I have dropped the idea of earning 10% by investing in XYZ because I find ABC more interesting. Now in ABC, my opportunity cost, that is the opportunity which I have left alone to invest in ABC, that is 10%. Now, instead of this being the opportunity cost, what we do is, we either take the cost of equity, that is the required return on equity, or the capital charge, that is the return required on the total capital, that is debt plus equity combined. This is only equity, this is the entire capital. That is debt plus equity combined in a simple structure. Now let's take an example to understand how we calculate residual income. Okay, let's say we have a company which has a sales of $1,000 million, a gross profit of 500, operating expenses were 200, earnings before interest and taxes of $300 million, interest expense of $25 million, and a tax rate of 30%. So all these values are in $1 million, and this is a percentage calculation, right? Now, whenever we are going to calculate residual income, we will encounter two ways of doing it. One is residual income with respect to cost of equity or required return on equity, this one. And the second method is residual income with respect to total capital charge, which can be also called cost of capital. So both this cost of equity and total capital charge, depending upon the problem that you are given, can be used as the required return or the opportunity cost. It depends on the problem. The problem may have the total capital charge mentioned in it, or it may only have the return on equity mentioned in it. In either case, this becomes our opportunity cost or required return. Now we have to calculate the residual income based on both these methods. Let's do that. Now let's make a few more assumptions. Let's say the book value of this company is $1,500 million. Okay. The debt amount of this company is $1,000 million. Okay. Now first of all, we will calculate residual income with respect to equity, that is required return on equity. Let's see how we do that. The total equity in the company is nothing but the book value, which is 1500. Now let's say the cost of equity is given by these parameters. We have a risk-free rate of 5%. We have a market premium. We have a market premium of 6%, and the beta of this business is 1.1, right? Now the cost of equity from this becomes 5% plus 1.1 into 6%. The value becomes, let's calculate it, guys. %11.6%. Now the required return on this equity is 11% of 1500. 11.6% of 1500. This is equal to 1500 into 0.116. This becomes equal to 174 million dollars. Okay, so this is the required return on equity. Now let's calculate what is our earnings. Earnings or net income is equal to earnings before interest and taxes minus interest adjusted for tax rate. So this is equal to 300 minus 25 into 1 minus 0.3, which is 0.7, right? So this becomes 275 into 0.7. This is 192.5. Now if we have to calculate the residual income by definition, it is the excess income over the opportunity cost, right, is equal to 192.5 minus 174. This is equal to 18.5 million dollars. This is our residual income with respect to equity or cost of equity. Now we will look at the second method, residual income with respect to total capital charge. For this, we have to measure two things. One is NOPAT. NOPAT is nothing but the net operating profit after tax. It is calculated as EBIT adjusted for tax. Why EBIT adjusted for tax? Can you decipher it from the formula, guys? Because we are taking the entire capital charge. So we are including debt and equity both, right? So interest becomes a part of the cash available to the stakeholders, right? So therefore we are not deducting the interest from the earnings. So we are keeping the interest intact. So earnings before interest and tax, we are only adjusting this amount for the tax. So NOPAT is going to be our actual returns, and we have to find out the cost of capital. This will be cost of equity into weight of the equity plus cost of debt into weight of the debt. Now this $1,000 million that we calculated, that we assume the debt of, is the market value, right? This is the market value. This is also the equity market value. This is our assumption. Now cost of equity we already know, 11.6% into the total is 1500 by 1500 plus 1000, which is 2500, plus cost of debt into weight of debt, right? Now the cost of debt is equal to interest adjusted for tax, interest percent adjusted for tax. Here if you see, the interest amount was 25, right? The interest amount was 25, the debt amount is 1000. So the interest becomes 25 by 1000, which is 2.5%. Now this becomes 2.5% into 1 minus 0.3, which is 0.7. This is equal to 1.75. Now weight of the debt is obviously 1000 by 2500. So we calculate it likewise. So the calculation becomes 11.6 into 1500 by 2500. This is equal to 6.96. This is a percentage, plus 1.75 into 1000 by 2500. This is 0.7. 6.96 plus 0.7. So the total percentage becomes 7.66%. Now the total capital is 2500, right? So capital charge becomes 7.66% of 2500, which is the total capital, right? So this becomes 191.5 million. This is our required return on capital, or the capital charge, right? Now let's find out NOPAT, that is net operating profit after tax. NOPAT is equal to earnings before interest adjusted for tax. This becomes, the earnings before interest was 300, I guess. Yes, see, it is 300. So 300 into 0.7. This is equal to $210 million. Therefore, the residual income the residual income with respect to cost of capital is equal to 210 minus 191.5. is equal to 18.5 million. Now this version of the residual income is also called the economic value added, or EVA. EVA is equal to NOPAT minus capital charge percent into total capital. Now if you want to calculate the residual income in percentage terms, it becomes 18.5 by the total capital. This is equal to 0.74%.